right, well, those are the headlines that we are tracking for you all evening on ET Now. Well, first up, let's talk about life insurance, a product that I guess almost is there in every individual's portfolio as a traditional investment class. But guess what? If you ask anyone under the age of 27, 28, they'll probably be looking at you with that bewildered look that why on earth do I need life insurance? Why should I be paying that premium for life insurance when firstly my income is not that high, and secondly I've already got a whole list of expenses to pay for, my rental bills, electricity bills, utility bills, plus aspirational items of expenses and expenditure as well. So where will I and why should I add one more item of expenditure on that ever-growing list? So today on the show we decided to make a case for that. We have with us Parag Raja, the MD and CEO of Bharti AXA Life Insurance, to take forward this topic. Parag, thank you so much for joining us today on The Money Show. It's a pleasure having you with us. So to start with, let's get down to the basics. We'll assume that a lot of our viewers are first-time life insurance purchasers. So we've come away with a lot of lessons in this last 1 year, looking at the kind of uncertainty that looms large. We don't know what tomorrow may bring. And that is something that has made people think that I need at least some sort of security, some sort of certainty. And we can achieve that at least on the financial front, thanks to this product called life insurance. So tell us, how exactly does life insurance do that?
Thank you, Mubina. First and foremost, let me start by thanking all of you for allowing us and giving us this opportunity to talk to the audience on your channel. Let me spend a couple of minutes in explaining some basic thumb rules of buying a life insurance plan, and I'll simplify it as best as I can. First and foremost, the question is, who should buy life insurance? And the answer is very simple. Anybody who loves their family should have a life insurance product. Life insurance actually is an act of selfless love, which you demonstrate because at a time when there is an eventuality in the family, a life insurance product saves and protects the dignity of the nominees who are left behind. And therefore, life insurance should be bought by anybody who loves their family. Number one. Number two is, how much should I buy and what product should I buy? Because there are just so many options and combinations, and what should I buy? Either if you're buying a life insurance product for the first time, or you're buying it for the fifth time, the first thing that you must remember is that the cover that you should have, the protection that you should have, or what we call is the sum assured that you should have in case something were to happen, should be minimum 10 times your expenses. If you are younger, below 40, this could be 15 to 20 times your expenses. And if you're above 40, it must be minimum 10 times your current expenses. And the rationale for that is simple, that in case something were to happen to the breadwinner of the house, and say he was providing 1 lakh rupees of income that helped the family take care of its expenses, then if I'm not there, I should have 10 times 1 lakh, which is 10 lakhs. And this 10 lakhs, which is paid to the nominees of the family in case of an eventuality, is then parked in instruments, the interest of which can take care of their current standard of living. So it's a very, very basic thumb rule. Then comes, which product should I buy? What I just answered right now is how much. What product you should buy? Everybody should start with a term plan, a pure protection term plan, because that is the cheapest way of buying a life insurance product category. A term plan is very similar to your health insurance product or your car insurance, where you pay X rupees, and if something happens to you, you get the claim, and if nothing happens to you, then you don't get anything and you pay again the next year. In most of the term products are very, very cheap, and I must share with you that India as a country has amongst the lowest rates when it comes to pure protection. A 35-year-old person who buys a 1 crore sum assured can get it for as cheap as 10 to 12,000. And for a person who's 45 years, it could be as cheap as 25,000 rupees a year. And therefore, it is the cheapest way of entering this product category and securing your family. So term plan is what you should buy. Very, very simple to understand. And in term, you also have an option. Many consumers in India don't want to lose the money that they pay. So they say, okay, fine, I will take a term plan, but give me an option where, the monies that I pay, I can get it back at the end of the term. So there are options in a term product, which is called a term return of premium, where all the monies you pay, if something happens, your family gets the claim. If nothing happens, then the monies get paid back to you at the end of the policy term. So this is about term. Now, this is for people who are not very, savvy when it comes to the stock markets, don't want to participate in the upside and downside of unit-linked products. Then this is a good starting point. If you're somebody who's well-versed with finance, who risk appetite is higher, then the next category is called the unit-linked products. And these are products, fundamentally, they participate in the equity markets, in the bond market. So that's something that a little more financially savvy person should get into. The third product category, Mubina, is called non-par, or in simpler terms, guarantees, which means that whatever you are saying and whatever you are showing in your illustrations, please ensure that I get that, and it's guaranteed. So this is a product category which is now getting a lot of buy-in from consumers. In addition to protection plans, we are seeing the guarantee products sell a lot because of the falling interest rates, and also because insurance is a product that allows you to park your monies in an X IRR for a 20, 30-year long duration of time, which no other financial product gives you today. So you've got the protection plans, you've got the unit-linked plans, you've got the guarantees or the non-par, and then you have the saving or the money-back plans, which are on the par platform, which is what India is very, very accustomed to, because before privatization, that is what most of the products that we all have bought as Indians are in these savings plans, endowment plans, money-back plans. So those are the four product genres or categories. And I also shared with you how much you should buy and which product category should you enter in. So I hope I've answered your question.
All right. Parag, let's talk now about, the younger cohort of the Indian population, the millennials, zillennials, Gen Zs. Of course, Gen Zs are not even thinking about life insurance. But if I have to catch the category of those under maybe 28, 27, 25, what's the case you'd make for a 25-year-old to buy life insurance?
I think that's a very, very good question, Mubina. So firstly, let me clarify that the one-year term product that you were talking about is not part of the sandbox, or the sandbox has other options and products that we filed, but I'll come to that later. Now, coming to the millennials, you hit the nail on the head. Millennials have limited income and expenses which are huge. They have to pay their bills, the rentals, the EMIs. Everybody has a smartphone, and this is a very, very digital savvy, generation. Now, insurance as a category is traditionally sold to people who are married, because the belief has been traditionally that if you're married, you've got kids, then, basis your life stage goals, you want to kind of buy insurance to protect those. So people generally save for children's marriage, children's education, their own retirement, and so on and so forth. Now, if you're a millennial or Generation Z, where you're not married, or you're in your early 20s, then why should you buy insurance? Especially at a time when your income is limited. The reason why most of them did not buy also was because the entry point for a millennial to buy even a term product with their income, they found it expensive. What we are doing as an organization, I'm very happy to share that we've launched a one-year term product. What this does, in all other term plans, you have a standard premium which you pay for the life of the policy. So if you buy a product for 30 years And if your premium is, say, 10,000 rupees, you pay 10,000 rupees every year for 30 years if you bought a regular premium. In a 1-year term, what happens is it's a single year policy that you buy, again, very similar to your health insurance and car insurance. And because it is only for a single year, the premiums are very, very low. And I think in a consumer insight, a survey that we did with millennials and Generation Z, we asked them that what would, you have so many subscriptions. You're subscribing to Apple, you're subscribing to Netflix, you're subscribing to all these video games. What if we could create a product for you which is very, very cheap, and you could do this for your parents? It's almost like 1,000, 2,000 rupees subscription that you pay for some of these facilities, like I mentioned earlier. What if you could do this for your parents, like a gift of love? And I think that resonated with them because of two reasons. One, it's not a very long-term commitment and they can reassess every year. And two, because it's a shorter-term product, the price point is lower. So I think, this is something that the industry has not focused on a lot till now, but this is definitely something that I believe the millennials would be really excited about, especially in these times, Mubina, where, all of us have experienced the biggest humanitarian crisis of our lifetimes. And people have now started to understand that insurance is not a push product and something that is last on my priority list, but rather is something that everybody must have. And both health insurance and life insurance must be at the top of the things that I want to do, because at the end of the day, you want to protect your near and dear ones in case of an eventuality. So that is my take on the millennials.
Oh yeah, like I said, right? We've come away with multiple lessons from the pandemic, this being one of them. Now, I know you briefly spoke about this 1-year term feature. So if you could just explain a little bit more, how does it differ from a regular life insurance in terms of premium coverage, etc.?
So 2-3 things about this 1-year term plan. First and foremost, when you are in a regular term plan, like I mentioned, the premiums remain stable. And therefore, when you are younger, you are actually paying a higher premium. And when you are older, it subsidizes, right? It cross-subsidizes. In a 1-year term plan, basis your age. If you're younger, the premiums are lower. And as you grow in age, the premiums will increase. So the thinking here is, the underlying thought here is that as your incomes grow, as your age grows, your income grows, and therefore, you can pay as you go. That's the first advantage of a 1-year term product. And therefore, it's about 40%, give or take, cheaper than a normal regular term plan. So that is the first reason why younger people, millennials, should look at this product. Number two is, when people are buying products, again, research tells us that the 3 big motivators for a consumer to buy insurance are affordability, claim settlement ratios, and finally, my experience on the digital onboarding process. So affordability, claim settlement, and the ease with which I'm able to transact with the insurance company digitally. These are the 3 big motivators for some of the younger generation to buy a life insurance product. And therefore, when they buy a 1-year term plan, it ticks the mark on affordability because it's cheaper, like I explained. The second thing, which is about claims, because at the end of the day, if there is a claim, it's a moment of truth. And at that time, my family should not be running around. And therefore, they must look at an insurance company which is high on their claim settlement ratios or the claim settlement rate. I am very happy to share that our company last year ended at 99.05% claim settlement rate, which means that if we received 100 claims, we paid 99.05% claims, and the balance decisions were taken. And if we rejected any claim, then it was because of misrepresentation of facts or the insurance policy was not renewed. So it ticks that box that you buy from a company whose claim settlement rate is high, and therefore you trust that in case of an eventuality, the claim will be paid. And the third, like I mentioned, is the ease with which I transact with the insurance company digitally, because this is a younger generation. And again, here, I think most insurance companies, because of the pandemic, have had to prepone all their investments on the tech side And now most of the processes are available on technology, on a mobile phone, where you need not transact a life insurance conversation face to face, which has been the traditional approach. But now you can have this kind of a conversation digitally. And if you like what the person on the other side of the screen is saying, you can pretty much do the onboarding process and the post policy servicing processes digitally. And it's very, very easy and very, very simple. It's as simple as, for a person, he can do it himself as well. But in some parts of the country, in the deeper parts of the country where you need help and assistance, a phygital model also exists. So these are the three things that people look for, the younger generation, when they're looking at the insurance product. And 1 year term, along with claim settlement rate and the onboarding experience digitally, which is very simple and easy to do, is the reasons why a person would go for an insurance company or buy this product.
All right, understood. Parag, now let's talk about the suitability of the different kinds of insurances. I know you were speaking about that in the very first answer, that there are different kinds of life insurance policies. The most simple one that, is like a beginner pack of sorts is a plain vanilla term insurance. But what about the others that you mentioned? What about those who have already been done and dusted with a plain vanilla term insurance, want to now explore more products? How would you explain them, and what would be their suitability?
There are basically 4 categories of products in an insurance company. First one is pure protection, which I spoke about. The second one are products which are called unit-linked products, and they principally invest the monies that you give them. They invest this in the stock markets. They buy a portfolio of stocks, and depending on the fund you choose, some percentage of it will go in equity and some percentage of it could go into debt. So this is the second genre, which is the equity linked products. The third one is simple. I pay you the money. Whatever you've told me is the returns, guarantee that to me. And these are called non-par products. That's the third category. So obviously between the second and the third, you might get lesser returns in the third category because the risk you are taking is a little lesser. And the fourth category, like I said, is common in India. We've all used to that. We've been used to that for many decades now, which is a pure, savings endowment plan or a money back plan, as it is known. You pay for X number of years, and at the end of the policy, in 15, 20 years, you get your money back. So those are the 4 categories. Now, we explained that for everybody, a term product is a must, and they must get that. So that is out of the way. Now that remains, you're left with 3. Now, if you want to engage with the insurance industry and decide on which one of these 3 to buy, it pretty much depends on your risk appetite. If you are a person who is not comfortable with the downside of the stock markets, then you should not buy a unit-linked product whose the fund you choose in the unit-linked product is very highly exposed to the equity markets. You should not buy that, regardless of whatever returns and everything that have been delivered in the past or expectations of the future. If you are a person who's conservative and who wants your basic principle back at the end of the term, maybe the returns is lesser, but please make sure कि मैं जितने पैसे आपको दे रहा हूँ, that money I can get it back. Then a guaranteed product is a very, very safe category where you pay the monies, maybe the returns are lesser, but they're guaranteed, and they're guaranteed over a 25, 30, 35-year period. This is a very, very big advantage for Indian consumers today, because we know that the rates, the FD rates, the fixed deposit rates in this country has come down over the last 2 decades from about 10% plus to now 6% range. And a guaranteed insurance product gives you a return of, depending on your age, sometimes between 5 and 6%. And there is no tax on this. So actually, it turns out to be very, very efficient from a return point of view, and it's guaranteed. So this is a product which consumers who do not want to monitor their product every day, not very active in managing their portfolio, are not very high on risk-taking ability, should go for a guarantee product suite or a par product. If you are a person who understands finance, who thrives by taking a little bit of risk, who enjoys and understands industry sectors then unit link is a great product category for those consumers who are okay with the upside as well as the downside of the stock market. In my last 2 decades in the insurance industry, I've seen that people, want to participate in the upside, but they do not want the downside of the stock market. And therefore, that's a distinction that we should make when we are advising to clients on which product category to take.
Okay. Parag, I know you briefly spoke about sum assured. I think a key component of life insurance which sometimes leaves us a little baffled. You spoke about how it should be an X percentage of your expenses. How do you determine that? If you could just elaborate a little bit more on how youngsters especially could decide on sum assured, because your family when you're young is composed of a particular number of members. As you grow, there's a possibility that that family will expand. So then how do you decide on expenses?
So Mubina, very, very interesting question. And that's the reason why data shows that a person who buys an insurance product once actually buys minimum 5 to 7 policies in his lifetime. And the reason this happens is for what you mentioned, that throughout the life of the consumer, his expenses are changing, his income is changing, his family composition and responsibilities are changing. And therefore, if I'm a 25-year-old who bought an insurance product at 35, my needs would have changed for sure. And just like with other decisions in life, as your responsibilities change, you will have to reassess and kind of readjust your commitment to insurance. The thumb rule, like I mentioned, very, very easy. There are a lot of sophisticated tools which will help you understand your assets, help you understand your liabilities, help you understand the gap. So there is a method to finding out the exact need for a sum assured or a product that a consumer should buy. But to keep it very, very simple, and this is something that has benefited in my interactions with consumers, is to keep it very, very simple in a language which he understands. And that is that whatever your income is or your expenses are, normally your income and expenses would be lower than your income, should be. So whatever your expenses are or your income is, please make sure that your sum assured is minimum 10 times your current income levels. And I think this is the biggest protection gap in our country. The number of policies that the number of Indians who own a life insurance product is not less. But the amount of insurance that they need, that the protection gap, as it's called, a survey that was conducted 2 years ago suggests that about 90% of the Indians are underprotected. So I have an insurance product. My father bought it, my mother bought it, and it was bought many years ago, and I've been paying some premium, and that's what I've inherited. But the sum assured is 2 lakh rupees or 5 lakh rupees or 10 lakh rupees. And if there were, in my case, if there was, an unfortunate situation where I didn't go home tonight, then I'm quite certain that that money would not be good enough to take care of the current lifestyle and dignity of my family. So whatever is your income, 10 times that is the minimum. If you're younger, it should be 15 to 20 times. And as you grow older, it should never be less than 10 times. So that's the thumb rule that everybody should follow.
Parag, really appreciate you joining us today. Thank you so much for taking our time and, just breaking down life insurance for all of our viewers. I'm sure it's been very beneficial for them to at least kickstart their journey towards that.